Okay, that is what we had studied: operating activities, investing and financing activities. This is the some of the examples. Operating activities: cash inflow, sale of goods or services, interest received, and dividends received. It may be in the investing activities as well: cash outflows, suppliers for inventory, employees for wages, government for taxes, lenders for the interest, others for the expenses. Investing activities: sale of property, plant and equipment, sale of investments, from collection of principal on loans and other entities. Outflows: purchase of investments, purchase of property, to make loan to other entities. That is, we are giving loans. That is, we are making investment in them. Then financing activities: always the sale of common stock, that is share capital, issuance of debt, that is we receive cash from by subscribing the debt instruments of other entities. Okay, now we have the question. This is the question. In cash flow statements, always there will be two comparative figures will be given to calculate the cash flow. Now, in the first instance, we calculate the differences and we readily know our answer what it should be. If we see the cash balances, that is from here, the cash is decreasing. And by which amount cash is decreasing? Can you calculate it?
Sir, isn't it increasing from 2016 to 2017?
Sorry?
The cash in 2016 was 37,000.
Yes, it is increasing. How much it is increasing?
$17,000.
17,000. So our answer, our difference will be 17,000 that we have marked it here. Now the second step is to find out the differences of all other head of accounts, or mainly you may say for the current assets and current liabilities. That will be good enough for the solution. So here,
Sir, we don't, sorry to cut you off, but we don't calculate the difference for the other assets, like for example, accounts receivable and inventory. And
we have to calculate it.
Oh, okay. So everything that is mentioned, we have to calculate.
Yes. Now what would we? And we will see it in the respect of cash impact. First, we calculate the difference, and then we will see whether the cash is increasing or cash is decreasing in this respect. So first, just start the calculation of the differences. Accounts receivable is increasing from 26 to 68. The difference is
42,000.
Inventory is obviously increasing from 0 to 54,000. But prepaid is
negative. It's decreasing. So
it can't be negative. We will write like increase or decrease, so as to ascertain the cash impact. Okay.
Yes.
Prepaid expenses are decreasing 2,000.
Yes.
This is all about the current assets. For fixed assets, we have to prepare the T accounts, so we don't need to have any calculated differences. Clear?
We don't use it in the investing activities, the long-term assets like land, building.
Right now, we are just we are measuring whether they are increased or decreased. Then we will classify it into the investing or operating and financing activities. The first step is to calculate the differences of the current assets and current liabilities and some other things that do not have another impact, just like land. We can also calculate the land impact. That is, land is decreasing from 70 to 45 because it is.
Sir, I have a question. We know that land does not depreciate, it appreciates. Then why is the value here decreasing?
It is sale or purchase.
Oh, okay, got it.
Done. So we have, in this case, we have disposed of the part of our land and we have received cash against it. That is the concept. So how much we have disposed of from 17 to
25,000.
20?
5,000.
Done. And this
Yes.
is accounts payable. Accounts payable are decreasing. Amount from 40 to 23 is
17,000.
17,000. And accrued expenses are increasing by
It's
10,000.
10,000.
Okay. Now in the question we have given some other data, like P&L and some other data. Operating expenses include depreciation expense of 36,000 and charges from prepaid expenses of 2,000. That is operating expenses here comprises of 30,000 of depreciation and 2,000 from that is prepaid expense. Now that is the answer to your question. Land was sold at its book value for cash. Land is always stated at book value, that is the amount which we have given it is the book value. So the amount for the 25,000 we have sold the land. Clear?
Yes.
Okay. Now the cash dividends were declared and paid. These were the dividends paid. So it will be in the financing activities. Dividend paid are always in the financing activities. Interest expense of rupees 12,000 was paid in cash, but there is also the interest expense, and it was paid. So the interest that was expense, it is also at the same time was paid for the 12,000. Now this is the adjustment. Equipment with a cost of 160,000 was purchased for cash with the cost of 41,000 and a book value of 33,000 was sold for 34,000 cash. We have to make workings for this. So we will see it later. Bonds of 10,000 were redeemed at their face value for cash. Bonds of 30,000 were converted into common stock. This is a bit rather technical, or you may say some advanced type of adjustment. We will do it later when we will come to it. Okay, common stock of $1 par of 130,000 was issued. Means we have issued shares to the public and we have got 130,000 for cash. Accounts payable pertaining to merchandise suppliers, that was nothing to do with. It is simple to understand, that is accounts payable. That is we have paid to the suppliers. Okay, now the cash flow format. Just like balance sheet has a specific format, and just like profit and loss account has a special format, similarly cash flow has also some special format. Cash flow statement basically begins with the net profit. It is a sort of reverse working. We have to eliminate the things which have no cash impact, or rather we can say that they are somehow incorporated. The cash impact is incorporated through some contra things. I will explain it. So net profit is net income 125,000. After that, we have incorporate operating activities. Which other subject you are taking?
You mean the class I have at
Yes,
9
yes,
p.m.?
Yes.
Yeah, that's
Hello.
for success factors.
Sorry?
It's my project training for SAP.
Okay. So you are studying all the courses in advance.
Yeah, actually, I'm trying to head start my career. So I did my certification in SAP a few months ago. So right now I'm doing my internship for that and a project training as well.
That's great. That would be very helpful. Okay, now
Yeah.
operating activities. In operating activities, we have to do first certain adjustments. This adjustment is for non-cash items, just like depreciation and gain or losses. Gains are deducted, losses are added back. Clear? This is the format. After that, we include that is working capital changes. That is impact of current assets and current liabilities. So if we start with this net profit 125,000 and we find the depreciation is given us with an amount of $33,000. If depreciation is not given, somehow it can be calculated through the details of fixed assets. Are you getting this?
Yeah, kind of.
Okay. And after that calculation of depreciation, we may get gain or losses amount. So they will be automatically adjusted here. Another thing is to do what? Working capital changes, that is current assets and current liabilities. Now, first, we are going through the working capital changes, that is from account other than cash, from accounts receivable to the prepaid expenses, current assets, and then accounts payable and accrued payable to the current liabilities. Now we have to just see the cash impact. See, if accounts receivable are increasing, we have to see its entry in terms of cash. If accounts receivable is increased, so entry would be account receivable would be debited, and for the time being, for the cash flow statement, the cash would be credited. So cash is credit means cash is subtracting out. One way to do this thing is like that, by making entry. Another thing is that to use the formula or to learn the formula, if current assets are increasing, they will be treated as outflow. And if current liabilities are increasing, they would be treated as inflow and vice versa. Now, anything you can adopt, but adopt one approach. Either use this approach, entry approach, or either use this approach.
Sir, I don't understand the second approach. We know that, like, for example, accounts receivable, it's an inflow of, like goods and resources into the company.
It is sort of just like it is an imaginary, you may call it, or is a notional. That is, account receivable is increasing. So in terms of cash, it would be credited, cash would be credited, account receivable is debited, and cash credited means that is outflow. First thing is that. And if we see through this approach, that is, if current assets are increasing, then it would be subtracted minus. Are you getting this?
Yeah, but why is it subtracted? Shouldn't it be added?
See, if we have to buy an equipment of $10 million, we have an option that either to buy upfront by paying this amount upfront, or by giving installment. Then if we agree on the installment, then we may pay 2 million as a first installment and the remaining over the period of time. So in this case, if anyone in a financial management, someone see this arrangement, then he may say that by this arrangement, you have saved $8 million, and it is in the form of cash inflow to the organization in other way. That is the second, we may say, the another uh, another picture of the story, another story of the thing. is that in this case we have saved 8 million. Getting this point?
Yeah.
So similarly, this is the same way. If account receivable are increasing, it means you have lost your cash. You are not collecting your cash immediately. So it's a notional thing. Clear?
Okay, so it's because accounts receivable is not about cash. It's just an asset that you
Yeah.
may or may not receive.
Since accounts receivable are increasing, means you are not receiving the cash immediately, and you have blocked your funds. So in a way that you are losing your funds, and losing funds means that is represented as outflow.
Oh, okay, got it.
Got it?
Yes.
Okay. So if we make a working of the working capital changes, it would be like this. Account receivable 42,000 minus inventory. Inventory is increasing. That is, we are paying for the inventory. Inventory debit, cash credit. So inventory would be 54,000 minus paying for inventory. But prepaid expenses are decreasing. So any decrease in asset is what credited. So one prepaid, if on one hand prepaid is credited, on the other hand, in terms of cash, cash would be debited, and cash debit means there is inflow, just like accounts receivable case. So we will write prepaid in a positive way, that is inflow in the form of 2000. Till now, clear all things?
Yes.
Okay. Now accounts payable. Accounts payable are decreasing. That is, we are paying off liability, and when we pay off the liability, our the cash from our organization will flow out of the organization. That is, it would be negative 17,000. Then accrued expenses, they are increasing. So current liability is increasing. It is cash inflow. So accrued expenses, cash inflow 10,000. Now we have incorporated all the current assets and liabilities. Now we will make the its net amount, and it will be called as working capital changes. So calculate it and let me know. What amount?
It's negative 101,000.
It is 121,000.
No, 101,000. 101,000.
Wait. This amount.
Yes.
So we can write it in the working capital changes. That is negative 101,000. Now the second part, after working capital changes, what you have to do, you have to work on the current asset side. Now we have seen this thing many times, that current assets may be depreciated on straight line basis or WDV basis. And I had told you earlier that we have a significant distinction between whether if we want to see whether the method is being applied as a straight line or whether the method is being applied on a diminishing balance. Can you tell me, by seeing these assets and their accumulated depreciation accounts, which method is being followed here? Straight line or diminishing balance?
For buildings, I think it's straight line because the cost is the same.
Okay.
They're just adding the accumulated depreciation.
But an equipment is
Equipment
They
is
both,
not straight line
no, they
method.
both are on a straight line.
But
Maybe,
in equipment, there are additions. So that's
yes,
why.
there may be additions, subtraction, or disposals. So the basic idea, also basic thing which through which we can distinguish between whether the method is straight line or diminishing is that if in the question accumulated depreciation account is given for the asset, it will be straight line method always. Clear? Because we have to
Yes.
make two accounts, two T accounts, one for the asset and second for the accumulated depreciation account. And in a straight line method, we studied that there will be two T accounts. And in diminishing balance method, there will be only one T account. It means there will be no accumulated depreciation given in the question. Then building or the asset will be at the book value, and that method would be the diminishing balance method. Done?
Yes. What about the units of production method?
It is rarely used. May not be given in the question. Now we have to make the T accounts of buildings and equipments so that we can ascertain the depreciation amount, the addition amount, the disposal amount, and the gain or loss amount. So I am drawing up here. You just follow. Building. Depreciation. Equipment. Depreciation. Opening. Opening is 200,000. Just follow the T accounts, what I am putting in. And if you have any query, then do ask me. Okay. And closing would be 200,000. Accumulated depreciation opening 11,000. Closing 21,000. Equipment opening 68,000. CD 193,000. Accumulated depreciation opening 10,000. Closing 28,000. Then we have just put in the values of the opening and closing in the respective T accounts according to the data. Clear?
Yes.
Okay, now read the additional data. What is being said? Equipment with a cost of 166,000 was purchased for cash. Just one line. That is equipment with a cost of 166,000 was purchased. So anything which is purchased is addition. So we will write here. That is addition or purchase 166,000. Clear?
Yes.
Secondly, what is being said? Equipment, another equipment with a cost of 41,000 had a book value of 36,000, was sold for 34,000. So can we write it like this? Equipment that had a cost of 41,000 had a book value of 36,000. So how book value is arrived at? There must be some accumulated depreciation, isn't it?
Yes.
So how much accumulated depreciation?
5,000. 5,000.
5,000. This is accumulated depreciation on the equipment which is being disposed. Okay. And it was sold for sale proceed was 34,000. So on selling this equipment, what we get? A loss or a profit? Gain.
Loss of 2,000.
But a loss on disposal 2,000. We have finalized this working. Clear? Now we have to put in the T accounts. T account means that any disposal on the still and method way is based on is if it is made, it will be on what? Cost? 41,000.
Yes.
So equipment will be credited, dispose 41,000. That is cost. Similarly, we had learned that the corresponding accumulated depreciation will be debited. So 5,000 accumulated depreciation will be debited on the disposal of asset. Clear? And this entry
Yes.
automatically adjusts the book value and sale proceed. This amount we get from the sale of the asset. This amount will be included in the investing activities, right?
Yeah.
And this loss will come here in the adjustment as a positive side. And now what about the T accounts? We have to see whether they are balanced or not. 200,000, no addition, no disposal, it is balanced. Correct?
Yes.
Difference 11,000 and 21,000. Difference is for 11,000 or 10,000? 10,000.
11,000. 10,000. Yeah, 10,000.
10,000. And what is this for? What this amount represents? You should know.
This is the disposal, right?
No. Why? It is accumulated.
No,
depreciation.
sorry. It's not.
Accumulated
Yeah.
depreciation building.
Yes.
Which amount is this? Fast, quick.
Accumulated depreciation.
No, it is accumulated depreciation is just CD 21,000. Hint. We started at the
Isn't that
beginning.
the yearly depreciation
Yes,
expense?
it is good. Depreciation expense for the year. Right?
Yes.
Now see for this T account, is this tally? 166 plus 68 is equals to 193 plus 41 or not?
No, it's not.
Why?
It's 166,000 plus 68 is 234,000.
234,000.
Yeah.
And what about this?
234,000.
So it is tally.
Yes.
Nothing to do with that.
Yeah, no.
Is this tally?
No.
Where is the difference and what is the difference?
Isn't it on both sides?
Sorry?
Isn't it on both sides?
Difference should
Because
difference should be on one side.
yeah.
See, this is what? 28 plus 5 is 33,000. This side is 33. And this side is 10,000. So the difference is
The
of
debit side.
23,000. Credit side. Hello. Are you getting
Yeah,
it?
sorry. Yeah.
And what this amount represents depreciation expense for the year on equipment. Clear?
Yes.
So we have got two depreciation. Depreciation on building and depreciation on equipment. Depreciation on building is 10,000 expense for the year, and depreciation on equipment for the year is 23,000. So the total would be what? 33,000.
Yes.
And in the question we have given what? The total depreciation includes what? 33,000.
33,000.
So in this way, it is also tagged. Done.
Yes.
So now we can write the depreciation amount here. That is 33,000. Clear?
Yes.
Okay. Now this is all about the operating activities. The maximum thing which can include in operating activities is depreciation adjustment, working capital changes, gain and losses. Clear? Now see
Yeah.
this interest. Okay. Your another sir can wait for us for 5 to 10 minutes.
Yeah, no problem.
Okay. Let's finish this question. Okay, here it is given that interest expense was paid in cash of the 12,000. And you can see that their interest expense was also 12,000. The expense which we incurred was immediately paid in cash. Clear? We will not take this amount in our cash flow statement, that is interest payment of 12,000. First, the answer is why. Why we will not take? The answer is that we are taking the net income after deducting these expenses. And this expense is specifically this expense is paid off. It means we have arrived at our net income after paying this expense. Clear?
Sir, I have a question for you. Now,
Yes.
what if they experience the same expense, the same amount of the same like interest expense in the same year? Like 12,000 but twice.
Not it is not twice. What would have we have if let's suppose we had made the entry, what we had done? Interest expense debit and cash credit. 12,000, 12,000. This expense has hit here PNL, and this expense was in this adjustment, in this flow. And the income is coming after deducting this interest expense which was paid. So therefore, no need to subtract it again. Are you getting this point? To avoid double counting.
Yeah, I got that point. But what if there was also, they said
Different
that they
amount.
experienced
Okay.
additional 12,000.
If there would be different amount, then something needs to be paid. It would be coming here in the line item that is interest payable. Some amount here, some amount here, and interest expense for the year. Then we have to make the T account for them for the interest payable, just like the accumulated depreciation. It would be like this.
Also, it would be mentioned in the balance sheet.
Yes, interest payable.
Okay.
Interest payable, opening, closing. Now interest expense would be debit and interest payable would be credit. So you will write the amount of interest expense here. And the balancing amount will be interest paid here. So it would require a working if there are separate amounts or different amounts. Got it?
Yes.
Okay. Now, after operating activities, we will do investing activities. Purchase or sale of fixed assets. We had purchased one fixed asset of 166,000. That is equipment. So we will write here purchase of equipment. It is outflow, so it would be shown as negative. Do remember, purchase of equipment is an outflow. Please show it in negative. Many students do not take care of this. They show purchase as a positive, and resultantly their cash flow becomes out of the balance. Okay. Sale of the equipment 34,000. So we will write it as sale of equipment 34,000 positive. Is there any inflow or outflow of anything in the investing activities? I think no. There is no any other investing activities. We are done with the asset side, liability side, accounts payable and accrued expenses are done. Now let's come to this adjustment. First we will write financing activities. In financing activities, we know one activity, that is payment of dividend. Immediately write this and get the numbers. Dividend, 55,000. It will be outflow. Now let's come to this part. Bonds payable and common stock, shares capital. Now see, first common stock. We had earlier 60,000 by issuing shares. Then during the period, we further issued the shares and get the finance from the public. Clear? How much finance we get from the issue of shares?
It's the difference, right?
Yes.
160,000.
How? 160. 220 minus 60, 160. Are you sure?
220,000 minus 60,000.
Yes.
Yeah.
It is 160,000.
Yeah, 160,000.
Okay. Then we have got 160,000 further cash inflow from the outsiders. So this would be from in the financing activity. And bonds payable. Also we have paid the liability of 40,000.
Yes.
This is minus, this is plus. Understand this scenario?
Yeah, so basically in common stock,
Yes.
they got more of it. So
Yeah, obviously.
more investors paid for the common stock. That's why there was an inflow of cash. But then for the bonds payable, they paid out some of the bonds. So there was a cash outflow,
Yes.
basically.
This is
Okay.
the thing. But the thing is not that straight. They're not simple. We have to see this adjustment. Bonds of 10,000 were redeemed at their face value for cash. Now, this another statement is very important. What it is being said here, bonds of 30,000 were converted into common stock. Right? Again, read this. Bonds of 30,000 were converted into common stock. It means, by seeing here, it seems like that we had paid 40,000, but actually we hadn't. We have converted 30,000 bonds into common stock, and actually we had paid the remaining, that is 10,000. That will be the outflow. Are you getting this point? Hello?
Can you repeat that again, just to
Okay, there is less than 1 minute. If you can log in after 2 minutes, then log in and just complete this topic. Clear?
Yeah, I'll log in
Okay.
again.